Welcome to Market Masterclass, and today we're going to look at the protection of life. We're going to look at life insurance. Wherever you go, you see big life insurance companies holding offices, and they play a very vital role in people's lives because you can protect the family, and companies can protect the company by getting life insurance on their directors. In the case that something happens to a director, then there's money available to fund another employee or to put cash in the company in difficult time. Same with a family. If a family, if the spouse dies, then there's immediate cash available for everyday living while they sort their new lives out. And this is very important. Usually a life insurance is best written under trust, because then that avoids going into a probate court, which might delay things by up to 1 year on the claim and the payout of the cash. Investment planning tool, of course it is, because in the event that something happens, a family makes sure there's a certain amount of cash instantly available for the family. That is at a time of great need. So life insurance also, in many countries, it makes sense, for instance, for a wife to be the policy holder on her husband, her working husband. She owns the policy in her husband's name, and in the event of his demise, then the policy belongs to her, therefore there is no tax payable, and that is obviously a very important aspect. To avoid capital gains tax, if you go into a mutual fund, an investment fund, and then the fund manager moves the money around, you're not exposed as an individual. You would be exposed to capital gains tax, but within a fund you're not exposed to capital gains tax, and very often it makes sense to have some direct investments because you can have an annual allowance. And also you can have some life insurance, which therefore avoids capital gains tax, and some direct funds, because in 1 year you can get a certain amount from direct investments, which is not taxable, and any withdrawals from life insurance, for instance in the UK, you can take 5% per annum entirely free of tax from a life insurance policy. So it's an investment, but it has a life insurance attached to it, and this makes it very interesting for large lump sums of money. If somebody takes out a private portfolio bond offshore, they can be in all sorts of funds, investing all around the world and buying and selling through the fund managers, and are not exposed to any tax whatsoever. Then they return to, say, their country, like the UK, they can take 5% per annum. If they haven't taken tax for 5 years, they can take 5 times 5%. So a very useful way of providing cash for beneficiaries to make sure that at all times, in all events, a family is well looked after. Just as an example, for instance, in the UK, you are not taxed on all your assets held overseas. However, if you are a citizen of the United States of America, a big brother wants to tax you on your worldwide assets. So you are exposed to tax. However, there are still ways of avoiding tax, not evading tax, avoiding tax, to reduce the tax exposure you do have at any one time. And this can be done for all countries. You have to talk to your accountant, you have to talk to a lawyer, and you need to talk to an investment advisor to make sure you are setting things up to provide the assets in the way that you want them to be held. And life insurance is a very, very beneficial way of assisting in that debate about who's going to get what when, because one doesn't know really what's going to happen, so one provides life insurance for the worst occasion, which one hopes will not happen, of course. So that's protection for life. I hope you found that useful and interesting. Bye for now.